Okay, now let's get into Dan's pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Dan, when I saw your top picks, I said, are you kidding me? Because I'll just say them right now. They're Mag 7. They're Microsoft, Amazon, Alphabet. And I thought, does it really take much to say, let's buy those three stocks? But to give you credit, it is coming at a time where the market has effectively thrown each of them out. So before we get into each, just high level, this is a bad year for tech. Mm-hmm. Why should investors scoop up these names?
So I had reservations about sending them too, because I thought, let me throw a little artisanal alpha your way. But we don't need to make this job harder than it needs to be. We don't win on artisanal alpha. We win on making money for clients. And I don't think there's a more obvious place to make money as we look ahead than some of the big tech stocks. So I think these companies are hiding in plain sight. So why is technology getting taken to the woodshed more recently? It's because expectations got really, really high for AI and AI derivative stocks, which is where the Mag 7 they're the most liquid ways to express that view in the market. They started getting too aggressive. And now there's cracks in that conversation. But that doesn't mean the fundamental position of any of these companies is truly vulnerable. And where it is, I think it's been more punitively express. And I think that sets up for an attractive payoff for clients.
Okay. And normally I roll my eyes because people are recommending it at all-time highs, which, that's fine because you can still make money. But you're recommending Microsoft, which is now trading at a more than 1 year low. Mm-hmm. It's been a while since I've been able to say that. The last time I obviously was 2022. So is that just a sell-off for no reason?
No, it's a sell-off for a reasonable reason. It's just you have to ask yourself, what is the second order effect of that? So investors said, Microsoft, we all know, and it's still, just because we all know, it doesn't mean it's not true. Microsoft is the most successful distributor of technology in history. So they have a relationship with the Fortune 5000, and that is an important anchoring. So whatever technology change and paradigm that comes, as long as Microsoft isn't 10 years late to it, they have a right to win. That's all true. So the AI conversation is why the stock went to north of 30 times earnings. And I think that's a reasonable barometer because it accounts for depreciation and the idiosyncratic cash flow effects that tech stocks can have sometimes. And now it's getting to 25 and lower. And that is, for Microsoft, I believe, a generational opportunity for it. Because let's talk about the AI thesis having cracks to it. That affects Nvidia more. That affects the power companies more. That affects a lot of other companies far more than Microsoft. But what makes Microsoft unique is they would love nothing more than to have OpenAI and every large language model commoditized, because as a distributor, you don't want proprietary technology sitting somewhere that you don't already own. So Microsoft is benefiting if there is a commoditization of LLMs.
So large language models. So it doesn't matter if OpenAI implodes. Not saying that is the case, but certainly it shouldn't be valued as much if you can do what they do at a fraction of the price.
Exactly.
Microsoft owns a stake. You think that's less relevant than the upside they'll get because all these large language models are now so much cheaper.
1,000%. They could write off the whole stake in OpenAI, and it would be a huge win for Microsoft. And here's a dynamic too with a company like this. All of the big tech companies, and including Microsoft, have spent so much money on data centers and so much money on compute that if they don't see a return on investment of that, and Microsoft is a very astute capital allocator, it's in the Satya Nadella days. If the AI revenue does not come to fruition, the CapEx is going to get massively cut at all these companies. And Microsoft is going to see a free cash flow wedge and an inflection, which means that suddenly we'll be talking about free cash flow conversion that's no longer in the 60s and back to about 100%. That's tremendous.
So I want to squeeze in Nvidia because it's not one of your top picks, but you did tell me you're buying the stock. All of this sounds terrible for Nvidia. Why do you still like Nvidia?
It's in the context of having technology companies. So it's all part of the balance, right? So we own a lot of garbage companies. We own utilities on one end of the barbell. And on the other end of the barbell, Nvidia is still one of the best, highest margin technology companies out there. And they're more likely to pinch out the Marvells, the Aristas of the world than actually lose share. So I do acknowledge that Nvidia's top line is potentially at risk as we look forward. But at the same time, even for Nvidia, it's trading at 18 times earnings now, but that's because the E is potentially at risk. So we size our Nvidia for our conviction. So we own disproportionately more Microsoft and some of the other companies we'll talk about than the potential company that's at risk.
And garbage trucks, you mean literal garbage.
Literal garbage company.
They're not garbage. They are companies that move garbage. Okay, let's get to your second pick. This one is Amazon. And this one too, like you can buy at the lowest level in 6 months.
And one of the lowest valuations ever for Amazon. And the reason why it's important today is Amazon is not the aggressive spender that it used to be. So the big CapEx that they put forward in their logistics centers has changed now. So they're in the other side of the CapEx cycle on retail. Their incremental margins in the retail business, which is one half of the two parts that is Amazon, is now moving to a consistent and high profitability level.
I want to underline that because so much of Amazon's profit has not come from the retail. It has come from cloud computing. And everybody just is like, okay, fine, we'll take the retail.
Yeah.
But what we really want is cloud computing. And you're saying that retail is going to start actually mattering for profit.
Retail is one of the fastest growing parts of Amazon now because they've been so heavily investing and now they're seeing the other side of that. So retail margins are moving consistently higher and have so for several quarters. And I expect it to continue to. At some point, you just can't spend as much money as Amazon was spending in retail. The next piece is Amazon Web Services. Don't count that out either. They have the same type of quasi relationship with Anthropic that Microsoft has with OpenAI. And once again, just like with Microsoft, Amazon would love to have the large language model layer commoditized. And they will do everything they can to make sure that happens. So AWS is still a high grower. When we talk about software companies, Salesforce is growing 9-10%. Amazon Web Services is growing 19%. So high growth, high profitability, and peak CapEx at a generationally low valuation for Amazon is also, I think, a generational buying opportunity for the stock.
And this is just a little anecdote, but for the amount of time that Amazon has been competing with Walmart, this year is the first time analysts project Amazon will finally have more revenue than Walmart, which is like kind of insane.
Yeah, it takes a long time in retail. And I'll tell you one more thing about that. It's a good point you brought up with Walmart. Take the leaders in retail as we've pure played and we've known them, Costco and Walmart. They're trading at almost a 10-turn premium to Amazon. So that's a big premium for what are the number 2 and the number 3 operators in the e-commerce world, and the ability to bundle. Amazon can't be beat.
I just want to underline that Costco and Walmart trade more expensive than Amazon. And that's just because everyone's throwing out tech right now.
Exactly.
Okay, these aren't so boring after all. Your third one is Alphabet, and this is the parent company of Google. And I think with this one, you can say there is a bit of hair on this story, and investors are selling the stock kind of reflecting that. Are they going to be leaders in AI? What are the regulators going to do with them? Although maybe under Trump, it's sort of a different thing, and almost no credit to robotaxis. They are so ahead of Tesla.
Yeah, so this is the hairiest of the three, but it's also priced as such. We're talking about Google, which doesn't have net debt on its balance sheet at 15 times earnings. So you have a discount to the broader market for a clean balance sheet, and we shouldn't count that out either. But let's talk about the core reasons why the moat is being viewed as at risk. And I wouldn't say it's a slam dunk that they get this right. So large language models, they have Gemini, and they're competitive right there with Anthropic and OpenAI, and lead depending on who gets their update out faster. But let's talk about the distribution conversation we've had with enterprise as it relates to Amazon Web Services and Azure with Microsoft. Google has a massive distribution footprint through Maps, through their local search offerings as well. So don't count out search and their ability to get search queries through Gemini and also improve core search in the way that they basically saved Reddit and made it into the meme stock that it is by trying to add more features to their search platform. So distribution matters. And this comes into the conversation around, they just got sued for effectively being a monopoly, and they lost the case because they are a monopoly. So the Department of Justice is throwing the book at them. And I do think that the outcome is going to be far more benign than what investors are hoping for as it relates to it because of the Trump administration. But at the end of the day, the risk is with Apple. If Apple walks away and Apple and Google basically have a bit of a breakup and split, that is the biggest risk for Google, not necessarily the DOJ.
And remind us of the relationship. Google pays Apple a lot of money to
$30 billion.
Yeah, to be the browser.
Yes.
But a lot of people have made the point that we're all so ensconced in Google's life that we would just choose it for ourselves anyway. Because didn't they do that in Europe?
They did.
And what happened to Google's market share?
They have about 80% market share there too.
So there you go.
So there's a risk that you lose search market share, but that ignores the fact that the market might just keep growing in search as a whole, and it might be additive, the same way that cloud has been additive to on-prem compute for the most part. But more important than all this is, let's not count out the fact that Google is one of the most bloated companies in the entire world. So if search has been a near basically 100%, sorry, that's a bit of an exaggeration because they got to pay their tax to Apple, but it's effectively a 80% plus EBITDA margin business. So why are Google's margins in the 30s? It's because there's all these other pet projects that have permeated the organization for the better parts of 2 decades. They can get financial leverage they can drive operating leverage even if top line slows down with the cost cuts. And at 15 times, it's not a tech stock anymore. It's basically a value stock.
How much upside?
30, 40%.
All right.
With the potential for more if they get the AI conversation right, where they dominate that in a way that they probably could with their distribution reach.
Dan, this has been an absolute pleasure. Thank you so much for joining me.